Hello, I'm Cameron with Check Bookkeeping. I work best with real estate investors, like fix and flippers, rental owners, burr investors, and I help them keep their finances organized. Using QuickBooks Online, I have a virtual bookkeeping firm where we're able to support people nationwide in the US, based in New York City, but I'm able to support anyone anywhere across the United States. So I've been using this YouTube channel to provide helpful content to real estate investors, particularly people that are trying to do their own books and trying to understand the nuances of bookkeeping. Bookkeeping for real estate investors is vastly different than bookkeeping for a general service firm. There's a lot more nuances and guidelines and specific things that need to be optimized for a real estate investor that may not be required for in any other type of business. So it's very important to ensure that you know what you're doing and you know what to look for on your financials. So this video is going to be specifically about the balance sheet for rental owners. So if you own a property, if you have a portfolio of rental properties, this is basically how to read your balance sheet for your rental business. So balance sheet is extremely important for real estate investors, especially for rental owners, because everyone knows about depreciation, hopefully. So as a real estate investor, you are basically likely getting into this business because it's almost considered financial freedom. And one of the ways to get financial freedom is to have a portfolio of properties. These properties are appreciating in value, so they're going up in value as you're going through different market trends throughout time. These properties are gaining value. You're getting free cash flow from, the tenants. And then at the end of the day, you received all of this income. There's a book value for the property. It's actually going down in value because you're able to realize these expenses, these paper losses called depreciation. So that's the beauty of real estate. One of the beauties of real estate investing. So in order to capture depreciation and to keep it accurate on your financials, you need to ensure that you have accurate and timely financials in bookkeeping. And you need to make sure that your balance sheet is clean. So we're going to talk about what a balance sheet is, why it's important, and how a rental business would need to read a balance sheet, right? So QuickBooks Online, in my opinion, is the best accounting software for a real estate investor. It has all of the tools needed in order to scale a portfolio to wherever you need it to go. It's able to keep track of all of your transactions, your balance sheet, your profit and loss, statement of cash flows, all of that stuff. QuickBooks Online is able to do it, and I believe it does it extremely well. So I'm a QuickBooks Online Pro advisor. It's something that I renew every year to ensure that I'm up to date with all of the changes. And, it's a certification that I keep for as I continue to expand my business. All right. So we're going to look at QuickBooks Online and how to look at a balance sheet. So this is the main interface for QuickBooks. So when you log in, this is going to be the screen that you would see. And your screen may be a little bit different because you may be operating on the older version. So go to the gear. Some versions of QuickBooks will have this box here where you can switch to the old QuickBooks. We're going to use a new QuickBooks because this is what is the future. And as this video gets circulated and more people watch it, they're going to be most likely be familiar with this newer version of QuickBooks. So we're going to use this one. So I'll show you how to get to the balance sheet. So to get to the balance sheet, you go to reports and you go to standard reports, and it's going to pull up all of the different reports that are available for your subscription, right? So for your favorites, there's always going to be 3 items. It's going to be the AR aging, I believe, which I just unstarred. I don't use that often. The balance sheet and the profit and loss. So if you see any other items that you like, you can start and it'll appear up at the top of the favorites, right? So we're going to be looking at the balance sheet. So for the purposes of this video, we're going to be looking at a custom report, a report that I've already created just for the purposes of this video. So custom report is basically any other report that's on that list. and you're customizing it to have specific features, specific ways of being able to view the report customized in that way. So we're going to look at a balance sheet for a rental holding company. So just to jump back, a lot of rental owners, portfolio owners will have multiple property LLCs to protect those assets of that LLC. So say you have one property, 123 Main Street, you would have a property LLC called 123 Main Street LLC. And then you should be keeping a bank account specifically for that LLC. You would be keeping books specifically for that LLC. You would not be mixing any other business funds within those LLCs, right? So in the event that someone slips and falls on 123 Main Street and that business gets sued, only those assets would be at stake instead of having your entire portfolio at stake. So that's one of the main reasons why people like to put things into its own disregarded entities. But one of the main important caveats of an LLC is ensuring that you have separate, accurate bookkeeping. So that means you keep books for each particular property. You keep bank accounts for each particular property. You don't mix the funds or mix the books. Everything stays intact. Okay. So on QuickBooks Online, we're actually able to track multiple LLCs on one subscription as long as it's the same type of LLC. It needs to be done in a very specific manner, and it needs to be able to generate a balance sheet and profit and loss that are specific to that one entity. So that's why it's very important that you really know what you're doing when you're having multiple entities in one QuickBooks subscription. It's very, very important because you don't want to mix and match and have any errors. You need to be very meticulous with this. So I'm getting ahead of myself, but I did want to mention why a lot of rental businesses have multiple LLCs, entities that they have to keep track of. So generally, just want to summarize that someone that has multiple properties would generally have a holding LLC where it's at the top level, and then below it will be multiple subsidiary LLCs, one for each property. So whatever makes sense for that particular real estate investor, and they definitely would need to consult with their legal expert and tax experts. I am not a tax expert. I am not a legal expert. I'm just going by what I feel is appropriate and would make sense. Okay. So we're going to be looking at a balance sheet at the portfolio level. So at the holding company level, at the top level. So we'll be looking at that balance sheet today. All right. So for a balance sheet, it's always on the as of date. So really when you're trying to pick the dates for a balance sheet, only the to date matters. The from date doesn't matter because the balance sheet is considered cumulative. So it's whatever, it pulls all the information from the past up into the present and tells you what the balance is after it accounts for all of the transactions that's happened throughout the course of your QuickBooks subscription. So this will only tell you whatever QuickBooks knows. QuickBooks doesn't know it, then it's not going to tell you that. So that's very important to know that the to date is what's most important. So if you go to August 31st, it'll tell you whatever your balance position is as of August 31st, 2023. So this one is for September 1st, 2023, right? So for balance sheet, it's in the name. Everything has to balance. So what does that mean? So everything has to balance as in assets, liabilities, and equity. So the accounting equation is assets equals liabilities plus equity. So assets is everything that the business owns. So that's the cash, the liquid stuff. If there's any accounts receivable, like any pending invoices that haven't been paid yet but will be paid. Any real estate, so that's your land, your buildings, your capital expenditures, any escrowed money that you might have. That's your assets. That's stuff that you own. And then your liabilities will be everything that you owe. So that's all your credit card balances. That's your accounts payable in the event that you use accounts payable for paying bills. That's going to be your mortgages, your conventional loans, sub-2 loans, seller financing loans, for money lending, all of that stuff. Anything that you owe to somebody is going to show up as a liability. And then your equity is everything that's left over. So if your assets are greater than your liabilities, then you have a positive equity. And the reverse, if you have more liabilities than your assets, you have negative equity. So that means you have less, right? So that's everything that's left over. So common things for equity will be everything that you've taken out of the business, so your owner's draws, everything you put into the business, your owner's investments, right? It's going to be your retained earnings, your net income, so on and so forth. So for right now, we're going to be looking at the assets. So that's the top of the balance sheet. So that's going to be everything, all your bank accounts. You want to make sure that everything that attached to this particular business, that bank account is linked to your QuickBooks and onto your bank feed, and you're categorizing all of the items to the bank feed. So a lot of common bank accounts for a rental portfolio will be the security deposits account. A lot of this really depends on the state guidelines. Some states require you to have separate accounts for security deposits. Really depends on your standard operating procedures for your rental business. So it will have all of those accounts. It'll have your OpEx accounts, operating expense accounts. It'll have your CapEx accounts, your income accounts. If you go, using profit first, right? So it's also going to have your cash position. So that's got your petty cash. In the event that you collect cash from tenants for rental payments, you may keep some cash in the drawer. For instance, if you want to pay like any minor items, you can just take it out of the drawer. It's very important that you keep track of petty cash specifically, and that you ensure that you keep track of it and you expense it out as needed. And if you're going to keep petty cash, you must have very meticulous records for that. All right. So that's certainly going to be outside of QuickBooks. You should have like a Excel sheet that has all the cash that you've collected, and cash that you've expensed out, right? And then also want to ensure that you reconcile those records every month. So when you're reconciling your bank accounts every month, you want to make sure you're reconciling your petty cash as well. All right, so your accounts receivable, in the event that you invoice out of QuickBooks Online using QuickBooks Payments, and you send tenants a link for QuickBooks for them to pay their rent, it'll show up as accounts receivable. A lot of rental owners don't usually use invoicing directly through QuickBooks, and they usually use a tenant invoicing platform, a tenant portal, right? So that would be like a Tenant Cloud, AppFolio, Baselane, those things that are specific for tenant portals. So since we're not doing any invoicing through QuickBooks specifically, it's not going to show up here, right? So next will be your fixed assets. So this is your real estate. So you need to make sure that your real estate is in specific buckets on your balance sheet. So that will be your land, your buildings, and your capital expenditures, right? So your land is never going to be depreciated. So you need to make sure that it's separate as a separate item. It's going to be very important for tax purposes as well, because when you have a balance, you need to ensure that stuff is separate. So you're not going to see that separate. It's going to be different from a flipping company, because everything is going to be bundled into the purchase price, and there's no depreciation anyway for inventory. So in my previous video, everything was bundled together as purchase price. But in this instance, since we own the real estate, and it's actually functional real estate that can be depreciated, we need to make sure that those two are separate. So we separate land, buildings, and CapEx. On the HUD statement, when you're acquiring a property, this is going to be bundled together as the purchase price, and it's going to be up to you to ensure that you separate the two into what makes sense and is what can be documented and substantiated. So you need to work with an appraiser, or you need to work with a tax professional. You need to get some substantiating proof for what the proportion of land is to buildings for your purchase price. So that's super, super important. All right. So in this instance, the land is $20,000. Building is going to be the purchase price. So it's whatever was was determined based on the split. So that's going to be the building cost. So now we get to the closing costs. So that's going to be everything else that's on the HUD statement, that's considered the closing costs. That's not going to be considered anything that's directly related to the loan, because that's going to be separately done. So this is going to be all of the closing costs associated with the purchase of the property. We also want to make sure that we separate the closing costs from the concessions. So if we're agreeing to pay certain items like property taxes on behalf of the seller, and we would need to make sure that gets capitalized into closing costs separately, because that could be depreciated in a different way. So those two buckets should be separate. So the seller concessions, any concessions, and then also the whatever else is left over. So your title, commissions, assignment fees, so on and so forth, right? So these items would be on a depreciation schedule. So it'll have the building amount depreciated, closing costs, the fees, the concession fees, and then closing costs remaining will be on its own depreciation schedule. So that stuff will need to be depreciated every year, and you need to be able to realize a depreciation expense, right? So that's going to be the amount for the buildings. So if we can collapse it, we'll see the full property basis amount is $192,000 for the building. So then next would be CapEx. So CapEx is going to be after you've received the property, you do enhancements to the property. You want to continue to appreciate the value of the property, and you want to increase the rents on your tenants. Then you want to ensure that you're improving the property to give a reason why you're increasing the rents. So this helps with your appreciation value of the property. So this will be our land improvements, for instance. So we need to make sure that would be separate from the land, because land is never depreciated. However, the land improvements can be depreciated. So that could be your fencing and anything that you're putting around the land to make it better. So that needs to be in its own spot, and that would be under CapEx. So that will be any like you're doing new flooring, you're putting in a new toilet, you're putting in a new bathtub, you're retiling, a new roof, putting in a new carpet, buying new appliances, a new oven, stove, you're buying a new refrigerator. These are high ticket items, and you're improving the value of the property. So that will be bundled into CapEx. So generally, CapEx would just be 27.5-year schedule, straight line depreciation. However, a lot of real estate investors that have high portfolios, they elect to do something that's called cost-like studies. So those are studies where an engineer professional will review a property, and it will be able to segment all of the different pieces of a property, generally the capital expenditures, and be able to have more accelerated depreciation. So depreciation is all of the stuff that you're able to write off as paper losses to help offset your income. So it's huge. So we would be using these cost-like studies. We will have to pay for it. We generally like to look for a high ROI, and there usually is a high ROI depending on your situation. If you have you have a big portfolio, you will pay a couple of $1,000 to get a cost-like study done. But at the end result of the cost-like study is going to give you a depreciation schedule, and a lot of the items can be bonus depreciated, where you can take the full amount of depreciation, and that will be used to help offset your income. So you can be getting all this free cash flow from your tenants, but you can be writing off all of this depreciation expenses to lower your taxable income. It is huge. So for our clients, if we're provided a cost-like study, it's going to be broken down into different year categories: 5 years, 7 years, 15 years, and then the general 27.5 years, right? So we would have it in different buckets on the balance sheet. So when they take this to their tax preparer, tax professional, they're able to easily see what the depreciation amounts are for each item, and they can see their actual position and their job costing, because it'll tell you them exactly all of the items that they've put into CapEx. So that's why it's so important to have your records very concise and accurate and clean. So you just look at a glance and you can just see exactly how much you've put into each thing, when it's expected to be depreciated. And then you'll be able to see those accumulated depreciation amounts on your balance sheet directly, right? So we would collapse this. This will tell us that there's 75,000 in CapEx. So next will be the capitalized loan finance charges. So when we receive a loan for property, we're getting, we have to get an appraisal in order to get the loan, the origination fees for the loan. All of that stuff cannot be expensed right away. It needs to be capitalized as a fixed asset and then amortized over the life of the loan. So amortized is the exact same thing as depreciation. Amortization is the same as depreciation. It's just for an intangible. So a depreciation is for something that's tangible, like property, an item, and amortization is depreciation for something that is intangible. So that would be these finance charges. So for the life of the loan, we need to make sure that we collect all of those startup loan fees at onset, and we would put them on our balance sheet, and then we would amortize them over the life of the loan based on the amortization schedule. This is one of the things that's very not really known among real estate investors. It's super important that you cannot just go ahead and expense this stuff. It needs to be captured on your balance sheet and then amortized. Okay. So that's really it for assets. I do want to jump to one thing for assets. So escrowed funds, so your PITI escrows. So in the event that you have the loan, right, and your lender requires you to escrow funds that will be used to make payments for insurance, property, and taxes. So you would see on your loan statements, as you're making payments to the loan, you may see some portions taken out from the PITI escrow to pay for these expenses. So your PITI escrow would show up on your asset side because that is money that you own. You just don't have it under your control. So you need to make sure that as you looking at your loan statements, if you see anything coming out of your PITI escrow, you need to check the balance, make sure that it proves to what you have currently, and then to make sure you're making those appropriate expenses as those payments being taken out from the PITI escrow. So that's another item that you need to ensure that you're reconciling. Another thing would be your earnest money deposits. So when you send like a LOI out and you have you're agreeing to put down like $10,000 as earnest money deposit as like a down payment, that will show up on your asset side because it's money that is your money. It is just maybe out of your control. It's sent to the law firm, a title company, whatever, and they're holding the money, and then it's going to be applied at closing. So when you come to get the HUD statement, it'll show you your purchase deposits or your earnest money on the HUD statement, and you need to make sure that that amount is the same amount that you have in escrow or that you have in your earnest money deposit line here, and then you would take it out at the acquisition of the property. So that's super important as well. All right, jumping down to liabilities. So liabilities is everything that you owe, everything that the business owes. So your accounts payable, if you use accounts payable, this will be like if you have like a bill system within QuickBooks, like the QuickBooks bill pay, and you collect, like if you work with a vendor that sends you supplies like lumber, you go like Home Depot, whatever, and you have like a credit system. So you would receive the materials and you would have like an outstanding balance. It's almost like a credit card kind of. But you have an outstanding balance and then you would get bills in the mail, you would pay the bills. So until the bills are paid, they would sit in accounts payable because that's technically money that you owe. Not a lot of businesses use that. Usually if you're on an accrual basis, you'd be using accounts payable. But most of the time, people will just be using credit cards or they'll just be paying like through ACH directly right then and there, and they wouldn't use accounts payable. But that's what a accounts payable is. Your credit cards. So you need to make sure that all of your credit cards that you use for this business are linked to your bank feed. You're categorizing all the expenses directly from the bank feed. So again, just like I said, for the bank accounts, you need to make sure that it's only accounts that's for this business. Do not have any other accounts that's from another business, and do not have your personal accounts. So in the event that you use your personal credit card for, you needed to go to Home Depot and you use your personal credit card and you spent like $400, right? There is a way to get that expense on the books. The way is not to put your credit card on your bank feed. You need to do a journal entry, and that's something I can show you on a later video. Leave a comment below if you'd like to see that video. But yeah, that's going to be credit cards. It'll show all your balances for all of your credit cards, itemized. Security deposits. So all of the deposits that we're keeping in our accounts needs to be accounted for as a liability, because this is money that is not ours. We are collecting the money, and we're going to be owing this money back to the tenant in the event that they leave. So this needs to be considered a liability. You would have a separate spreadsheet or some type of Google sheet that'll have each tenant, their unit, how much money that you're holding that's as a security deposit, and ensuring that you reconcile that amount to your balance sheet here as well. So that's very important. So as people leave, you need to make sure you zero out certain areas on your sheet. Next will be the loans. So that's going to be your private money loans, conventional loans, hard money loans. This could be like your home equity loans. This can also include your like SBA loans, like business loans that have nothing to do with the property, that you just have to get some extra cash position. This can also include like home equity lines of credit. Well, home equity lines of credit generally will be under credit cards because that's more of a revolving credit basis. But those are the type of things that you would see here. So as you're making payments to your loans, this balance will lower. When you make payments to the loans, usually going to be in three parts. It's going to take money from your PITI escrow for certain expenses. It's going to take money from, you're going to be making payment to principal balance to lower this amount. And then there's going to be a portion of that payment that's going to go to your interest. So that's going to be expenses and interest expense, and that will show up on your profit and loss, right? So that's really it for liabilities. Then equity is everything that's left over. Retained earnings is your net income from the previous year. So the December 31st net income that will roll over into retained earnings, and this amount will be the same for the entire year, and it's just going to be the net income from the previous year. So this basically indicates that there was either no net income, it was zero, or we just started the business this year and we didn't have any retained earnings because we weren't in business last year, or QuickBooks wasn't active last year. Net income is going to be your cumulative net income for this year. So starting from January 1st up until September 1st, 2023 is going to be your net income. So this will be pulling from your profit and loss. Your members' contributions. So in the event that you have multiple partners, you would have members' contributions for Jane Doe, members' contributions for John Smith. So this will be everything that's contributed to the business. So like say I put in $125,000 for my personal, I contributed it to the business. So it's going to be adding to the equity. And then distributions would be everything that I'm taking out of the business. So this means I'm taking out $34,000 out of the business. And then that'll yield you your total equity. So as you see, your assets equals your liabilities plus your equity. Okay. So this always has to balance, always. We're also able to drill down into this in the event that we're tracking multiple entities in one QuickBooks subscription. So say this is the holding LLC and there are subsidiary LLCs. These land amounts might be a lot bigger because it's capturing the other subsidiary LLCs onto this master balance sheet. And then we're able to drill down into those LLCs to get the more granular balance sheets, right? So that's why it's super, super important to ensure that if you are doing your own books and you're keeping a large portfolio of all of your properties and LLCs into one subscription, that everything is accurate, clean and accurate. So it's always super important to be meticulous as you're categorizing items, and you want to make sure they go to the right property LLC. Okay. So yeah, that is balance sheet for rental portfolio owners. All of the main specific points that you need to be looking for on your balance sheet. So if you don't have any of these items, or you're missing some of these items, you definitely want to ensure that you take a look at your balance sheet and you make the appropriate changes. So I'm always looking at the comments. Please leave me any questions that you might have about this. And if you have any other topics that you would like me to cover regarding QuickBooks and regarding real estate investing, bookkeeping, just any general questions, please leave them in the comments. I'm always taking a look at those. Check my description. I have free resources to help you on your bookkeeping journey as you're trying to get your books ready and straight together. I have some free resources that can support you through that process. In the event that you are overwhelmed with bookkeeping and you just don't want to do it anymore, but you know it has to get done, I have a bookkeeping business where I help real estate investors, specifically house flippers, rental owners, get their books accurate and organized using QuickBooks Online. I'm able to help you create a QuickBooks subscription, get you onto QuickBooks, and get you the right chart of accounts and structure for your business type. I'm also able to get you a QuickBooks Online Pro Advisor discount. So since I'm a Pro Advisor, I'm able to provide you with a 30% discount on your QuickBooks subscription if in the event that I'm the one that's doing the books. So I'm going to leave my link to book a call in the description of this video. Feel free to book a call if you're interested. If you have any other topics that you'd like me to cover, please leave it in the comments. And thank you for watching.